Good news! Goldman Sachs have just released their mid-year report, Equity Bear Market, a Paradigm Shift. This is out of their global macro research team. It's about a 60-page document. So let me save you the trouble of having to read it and just give you the best bits and the most important bits as I see them. One of which is this one. Unprofitable tech is down more than 50% year to date. It's the ones which are unprofitable amongst technology companies which are really dragging things down. This market is not interested in companies without profit. It's not interested in companies with poor cash flows. It's not interested in companies which are profitable but overvalued. And you can see you really got whacked if you had unprofitable tech companies. You'll know from my value growth income algorithms, we only invest in profitable companies. And this is one of the reasons why we look for valuation, earnings, i.e. profits relative to share price, revenue growth, cash flow growth. So that was one of the images which caught my eye. Another one from Goldman Sachs in that report was just reiteration of the fact that value has outperformed growth amid the sell-off. Well, I don't see them as two separate things. Value tends to mean companies which, relative to their profitability, are underpriced. Price earnings ratio is one measure of that. Price earnings growth is another. Discount cash flow is another. Growth tends to mean companies which are unprofitable, but sales are growing sharply. Well, I prefer companies which have got high sales, good profits, growing revenue, growing cash flow, strong cash flow, low share price. In other words, I want to tick every single box going. Okay? Because if I want it in my portfolio, then it better meet every single criteria. So I thought that, again, I know tactically we will emphasize value, but we're naturally in there. We're naturally looking at value stocks only because, guess what? I can't pick growth stocks which are not value, and I can't pick value stocks which are not growth. So we don't have the problem of the sharp generic falls that you've seen in growth companies. Okay, so what next? Well, the other thing, or the next thing to catch my eye, was this image. S&P 500 drawdowns of more than 15% since 1950, and guess what, we're in that example right now. And really what they're asking is, well, is this common? Yes, it is. Does it necessarily mean there's a recession? No, it's a pretty mixed bag on that. What was the source of the drawdown? Monetary oil, financial panic was once, growth, fiscal. Well, the way we are at the moment, we've probably got a bit of everything. It's a growth worry, fiscal tightening, i.e. higher taxes, monetary tightening, i.e. higher interest rates, and oil. You've got everything on this one. Does that mean it should be a deeper fall? Well, could be 48% in 1973. That was oil and it was monetary led. I don't think we're that bad yet on that one. So I won't say we'll go as far as that. Anyway, I thought it was an interesting chart. Sometimes you look at this information, doesn't mean you're necessarily going to walk away any the wiser. We expect earnings will lead equities higher by year end 2022. That's pretty impressive for Goldman's to stick their neck out, and JP Morgan are doing the same as well. I think it was JP Morgan or Morgan Stanley, one of the big banks. And this is what they think by year end, from where we are at the moment, they expect will go a little bit higher up there. So there you go, that's a bit positive. In other words, they're almost saying we've hit the bottom of the market and profitability will lead equities higher. That can only happen if our expectations of profits are below the ones which the companies will actually end up announcing. So keep an eye out when the companies announce their profits. If the stocks continue falling, it's mean we were just still expecting strong earnings. And this becomes a vicious, unself-fulfilling prophecy, because by reading this, other analysts might say, oh, I'm optimistic about earnings. And then when the earnings narrowly missed, they go, oh, they missed. Whereas if Goldman Sachs had said earnings will be awful, the market's going to fall, everyone reduces their expectations, and a slight earnings growth leads to a rise in the markets. So here, Goldman's have done the market a disservice and will be quite potentially 100% exactly wrong if you look at the sort of self-fulfillingness of these things and how they work. Okay. Several other things I want you to look at. Do not forget alpeshpatel.com. alpeshpatelventures.com/links. There are a whole load of free things such as my books, my webinars, portfolio review, access me on LinkedIn, and so on. If you're interested more in trading, have a look at pipspredator.com. I've got a great blog there, completely free information there on the blog. Scroll to the bottom of the page on pipspredator.com and you'll get a whole trading blog, which will keep you up to speed on that kind of thing. Campaignfor1million.com has also got a whole ton of my free things. And then come and visit me. Come do my summer school over 2 days in Spain, alpeshpatel.com/Spain. That's the place you want to be, 27th, 28th of July, and I will see you there. Short of that, do visit those sites. Like my video, subscribe, follow, hug the screen, all those things, critically important for us to stay in touch. Otherwise we might fall out and then both our lives will be the more worse for it. Thank you all very much.